A happy morning to all of you. This is Magdalene from Itus Capital, and I'm glad to welcome you all to our 2Q Investor Call 2024. Thank you all for taking the time to be a part of our Saturday call. At this time, all the participants will be in listen-only mode, and after a brief presentation by our founder and fund manager Naveen Chandramohan, we will have the Q&A session. Today, Naveen would walk us through on our portfolio performance in the last quarter and discuss his views on the market. Let's hear it from him. Over to you, Naveen.
Thank you, Magdalene, for this, and thanks to everyone again from personally from my side for making time off on a Saturday morning to join our call. Today, I'd like to keep the presentation brief and then hopefully open up the floor for Q&A where we could look at answering more questions than normal. I think it's important to set the context because a lot of the people have varying views on the market. I see a certain set of investors wanting to become extremely aggressive, moving to more small cap focused funds, which one can reconcile from the flows. Other set of investors being cautious, keeping money on the sidelines, wanting to deploy if there is any correction. And I think both set of investors can be right at the same time. It depends on how long it takes for corrections to come. That is borderline prediction. What is more important to a firm like us is the value of understanding cycles. Multiple times in the last 1 year, I've made a statement saying that we are in an inflationary cycle. And the more data points that come out, the more this corroborates that we certainly seem to be in an inflationary cycle in India and globally as well. Now, why is this important to contextualize? Is inflationary cycles are always good for equities, hard assets, gold, real estate. So once one can contextualize this, positioning portfolios become that much more important. Generally, when we talk about portfolio construction, you're talking about three decision-making broad contexts that one needs to look at. A, what is the company to buy? B, what is the exposure to look at, which is in terms of how do you position size? And finally, how much do you deploy at a portfolio level in terms of maintaining cash? These three will ultimately determine your ability to outperform over cycles. Now, one of the aspects of cycles is even a country like India goes through significant cycles where certain sectors tend to outperform and certain so-called structural sectors that we believe today also tend to underperform. For example, I always say this, a good business in a bad cycle does not mean you generate returns. What do I mean by this statement? Right? Let's take one great business in the consumer space, Asian Paints, which has given phenomenal returns between 10 and 21 at almost 28% IRR. But 2000 to 2010 was not a consumer cycle, and Asian Paints was still a great business even back then, generated a 2% IRR over 10 years. One of the portfolio companies that we own, where we have a reasonable overweight, is ABB. ABB also went through similar cycles. 2000 to 2010, ABB generated a 32% IRR. The same ABB in 2010 to 21 environment generated a negative 2% IRR. Company didn't change, the cycle changed. So 2000 to 2010 was an inflationary cycle. 2010 to 2021 was a deflationary cycle. I'm not talking about India, I'm talking about globally. So certain cycles favor certain sectors, and it's important for us to get our positioning right. So it's just not talking about this is a business, long-term will all make money. That's good. But end of the day, unless and until we position towards the right cycle, it's not going to make a value accretive difference to the bottom line of the portfolio. Now, cycle is always certain things that you might get wrong as well, because it's not easy to say next 3 years, this is the certain cycle that has to plan out. You have probabilistic assumptions that you make, and then you validate that with data. But one thing that is definitive, if a certain cycle works in your favor, is ROEs for that sector will tend to expand. So I'll give you a breakdown of where we are positioned. I've taken three sectors where we have slightly overweights against any index that you would compare or benchmark. autocoms, oil and gas, and telecom. These are cyclical sectors by their very definition. For example, telecom is seeing pricing power for the first time after almost 8.5, 9 years. And all of that pricing power is coming through because the largest player has now stopped cutting prices, and that hence the industry tends to benefit for the next 2 to 3 years, typically during such cycles. Now, when you have an inflationary cycle and pricing power accrue at the same time, typically this leads to ROE expansion. And this is a point to validate whether you are in a right cycle or not. When an ROE contracts, it generally means at a sector level, you're facing headwinds. There could be one or two anomalies which could buck the trend, but it's like saying, I am going to be driving in a crowded lane. Returns may not accrue, even though you might invest in a good business. Now, again, what is the importance of trying to look at constructing a portfolio with a high ROE? The slide here explains to you the so-called base P multiple for a certain growth rate and a certain ROE. And I'll just explain what this slide explains. So let's take a company which functions at a 20% ROE and another company that functions at a 70% ROE. Now, the same company for the two different companies with two different ROEs for the same growth, the market will give it different P's, because market will always give a higher P to a higher ROE company. That goes without saying. But that doesn't mean a higher P company means it has to fall. What happens when a company falls is growth rate stalls. Now let's look at a scenario for two different companies. If growth rate drops by 1%, which means, 10% on the base rate. So 10% growth rate drops to 9%. The lower ROE company will go through a PE derating of almost 33%. The 10 PE goes to 6.67, a rough PE contraction of 33%. Whereas the higher ROE company, the same PE contraction is roughly around 12.5%. So what a higher ROE company protects you at a portfolio level. Even if you get your growth wrong, you will actually get protected on the downside. So end of the day, there is a lot of debate on whether the market is expensive, the market is cheap, or the market is fairly priced. Now, you will talk to 10 people and you will get 12 different opinions, which broadly end of the day tells you it doesn't matter because no one knows. But what you can know is when you don't compromise on ROE, which goes back to your initial argument of saying when you invest in the right sectors, basis the right cycle, even if the market falls, your portfolios do get protected. And it's a very important point to understand, especially in the bull market that you are in. And even in a bull market like today, it's only less than 8%. It's not today. If you look at it over the last 25 years of proper data-driven Indian history, less than 8% of the companies show more than a 14% ROE at any given point of time, which means ROE accretive nature of businesses is not a given. Stock price moving is a different thing. So for example, today, Itus does not own any railway stocks, and we wouldn't either. It's done very well. But end of the day, railways as a category doesn't lend itself into ROE accretive businesses. Even today, where the order book is extremely robust, stock price might even double from here. I don't have a view on that. But when it falls, and I don't know when it will fall, but it will over the next 1.5 years, the fall is not going to be muted. It is going to be significant because you don't have ROEs to protect you when the growth falls. So it's an important part of understanding how we look at portfolio construction. Going back to the performance this year, Itus has seen outperformance against the benchmark. We continue to do our performance against benchmark both this year and since inception has been a healthy outperformance. Since inception, we've beaten Nifty by 4.3%, net of fees and expenses. This year again, we've beaten Nifty by 2.5% as of June 2024, net of fees and expenses. All of these returns are calendar year returns. Now, how are we positioned portfolios as we speak? Many people have called this a contra portfolio. It's not been constructed with a contra positioning in mind. It's been constructed with the aspect of where we think we are in a cycle. Like I said, I believe we are in an inflationary cycle. In an inflationary cycle, certain sectors which have cyclicality in them tend to do better, which is where you will see us positioned higher than normal in telecom, higher than normal in oil and gas. We're structurally bullish power. That's where we are overweight as well. Industrials, cap goods, manufacturing, we continue to be overweight. Though we've been overweight auto for a while, we have been trimming in the last few months in order to rebalance some part of our risk. And we continue to be structurally underweight banks. And that I don't think will change anytime soon. We are tactical IT, so we might increase our exposure in IT. For example, in the March quarter, we had pretty much no exposure to IT. Now we look at adding back some IT exposure. We'll continue to be tactical IT. I don't think IT still is a structural theme. Why do I keep talking about an inflationary cycle? I spoke about telecom pricing power. Many of you may be aware that once Jio increased prices, so did Bharti, and that will actually translate into higher ARPU for telecom players after a long time. And this should actually accrete directly into cash flows for many of these businesses. All of these businesses have been delevering over the last 2 years, and you'll continue to see the balance sheet delever over time. The second chart basically explains to you what we in India have never seen in the last 25 years of our existence. The differential between US and India rates has never been this low. Yes, there is talk of Fed rate cut going into year end, which I do believe can happen, but I don't think that necessitates RBI to cut rates because we have managed inflation fairly well. I don't think they'll raise rates, but over the next 3 years, if you ask me the path for interest rates, I think it's higher rather than lower in an aggressive way. Now, broadly, if you look at market valuations, there are reasons to paint both sides of the coin. For example, if I look at small caps, and again, small caps is a very broad sense today because I've been highlighting this. The smallest so-called small cap in India is 22,000 crores of market cap as we speak. The median market cap of a small cap company in the US, which is roughly almost 10 times our size in market cap, is 7,500 crores. So I think that word is getting used very loosely, but there are certain sectors that do appear frothy. And those are sectors where you can lose liquidity very easily. But if you take the broad market, which let's say you talk about the top 50 companies of India, from a price earnings perspective, it doesn't look we are expensive. In fact, we are actually below the median end of the range as we speak. From a price to book perspective, we are slightly at a 10 to 11% premium to our long-term averages. So you're neither cheap nor expensive here as well. So the important point to realize is rather than saying the market has gone to an all-time high and hence it has to correct, I'm not sure that argument necessitates too much of merit yet as we speak, though there are pockets to believe sentiment is getting greedy on the ground. Now, one of the data points that we put together is the fact that promoters in India have been selling stakes. As you can see, the number of firms, number of listed companies in India where the promoters are selling stakes, it includes MNCs, it includes PE offtakes, it includes OFSs that come from an IPO is going up. While there is one school of thought that there is overvaluation, the flows of money continue to go towards subscribing these IPOs because these IPOs continue to get bid up. And that's some areas where there is froth. One of the things why the market is getting supported through all of this actual supply is because of the DII flows that continues to be robust. Just to put it into perspective, right? While everyone talks about market needs to correct, when we set up Itus in Jan 17, I still remember the SIP flow in India was around $220 million per month. That same number as we speak is now at $3 billion per month. So we have seen COVID. We've seen GST, Demon, RERA. I've seen 3 times Nifty correct 15% in the last 7.5 years. But the SIP money has gone up 15 times through this. This to me is structural. I don't think this is cyclical. We are going to go through multiple periods of drawdowns over the next 3-4 years, but I don't see this money come down. And in fact, I say this, that this to me is the 401k moment for India. In India, we don't have a 401k. We have EPF, etc. But the fact of SIPs going to this scale is a 401k moment, which I think is structural. And hence, rather than spending too much of time saying where valuations are expensive and I want to time the market, I would much rather focus on where liquidity does not get sacrificed, what are the sectors to position in, and where valuations are still within reason. Again, if you look at the top chart, typically all value investors who like to quote Buffett like to quote this metric as well. We use the market cap to GDP number, where we basically say that India is at the higher end of the range at 132%. But the same value investors who say India is expensive are actually investing more money into the tech companies in the US, where market cap to GDP, the same ratio is 197% as we speak. Right. So there is a lot of dichotomy as far as liquidity and money flow is concerned. And that's what I would pay a lot of attention to at the moment. Now, interestingly for India, while the market cap to GDP ratio is at the higher end of the range, the argument for this valuation to continue is the fact that ROE for the structural part of the economy is expanded. So if you look at it, the 10-year average ROE for the market, the so-called quote unquote market, has been at 13.7%. And today you are at the higher end of the range. In fact, the highest end of the range that you have seen over the last almost 15 years. So unless and until there is a very meaningful case for earnings to degrow, which effectively means ROE should contract, to have a significantly deep correction in the markets still looks unlikely. You could have falls. I mean, a 4 to 5% fall in the market is par for the course. But when I say significant, I'm talking about a 15% correction. I'm not talking about 30 doomsday. I'm talking about a 15% correction, which is meaningful. Unless and until you see earnings degrow, which still is not the case yet, a significant correction is unlikely anytime soon. However, having said that, it's important to still not lose discipline. Like I have maintained in the past quarters, the portfolio of Itus continues to be and resonate more like a largish cap portfolio. Our overweight, our incremental exposure that we are adding is in market cap of the large cap companies, be it in pharma, be it in oil and gas, be it in power, or insurance, etc., that we've been adding over the last 4 to 5 months. And we continue to maintain a small cash component. So the cash component is just to ensure that we don't lose sight of discipline in terms of how we fully ramp up portfolios. And if we do get a correction, we would want to increase our portfolio, but we don't want to have too much of cash either. So if you look at the weighted average market cap of the portfolio, it's roughly around 2.36 lakh crores, which will look like a largish cap portfolio today. Finally, while I have sent the quarterly letter as well, I'm basically segregating our portfolio by sectors, by weights, around where we are invested in. And if you look at it, there'll be roughly around 36 to 38 businesses in any portfolio today. I have maintained this in the past, that this is not an environment I'll be comfortable to concentrate investments yet. There are certain businesses that we might look at concentration more so in the large cap space. Otherwise, the portfolio will be slightly more broad-based in this cycle as we speak. With this, I'm going to conclude our part of the conversation. I'll open the floor to questions and we'll look at answering any questions from here. Thank you so much for your time.
Thank you, Naveen, for the update. Participants who have any questions can feel free to type in your questions in the Q&A button. Identity of participants is protected as the questions are only visible to the panelists. Naveen, I have a question here. How do you see the market moving with so much money coming into the system?
Sorry, how do I see the market?
with so much money coming into the system, right from DIIs to SIP flows to into the both from into the market as well as into the economy.
So let's try and quantify this money, right? Because when we use words like so much, unfortunately, we don't tend to contextualize the number. So one aspect is just to look at it from $1 billion perspective. That again doesn't make sense because as your economy grows, then the $1 billion that you spoke about in the last decade is going to be lower than the $1 billion this decade. But if you look at, so I was reading a recent report, maybe 3 months back from Goldman Sachs, where they were talking about roughly 5 to 7 years back, your mutual fund number in terms of investments, which is what you refer to as DII flows, to FD ratio, that number was roughly at 2%. Over the last 7 to 8 years, that number has gone to almost 10%. Now, what this effectively means is participation from the Indian investor typically used to be predominantly with FDs, gold, and real estate. I don't think that will change significantly, but the 2% has gone to almost 8.5 to 9%. It is reaching low double digits as we speak. Now, for example, if we believe India's market cap has to grow structurally over the next 10-15 years, this 10% has to grow closer to a 30-35% number like the US. I don't think this will happen in 2, 3, 4 years. It might happen in multiple decades. But the structural part of more money coming into the economy and the markets is real. So I don't see that change materially, but you will see cycles for that money change. Now, one of the consequences of money flow is money flow goes to the point of highest returns, and that's where bubbles also tend to get formed. You will see that in India as well, where froth will get built up in certain sectors. But to predict where bubbles will break is always going to be extremely hard. And hence, you counterbalance that by saying, I don't want to lose liquidity. I want to ensure I protect downside at every stage. I try and position myself less so in small caps, less so in where there is less liquidity if any kind of drawdown happens, such that if we do fall at any stage over the next, let's say, 4 to 6 quarters, the fall will always be a lot less. That's broadly how I would say we think about this.
Understood, important. How do you see where the market is? And you also see promoters selling stake. Do you see the market being overvalued at this point?
So I think there are two parts to this question, right? Again, market being overvalued. So if it is purely India which is going up on euphoria, then I would have concern. Today, if you look at our last 6-month return, which is this year, calendar year, US has done better than India. NASDAQ has done better than India, predominantly driven by NASDAQ. DAX, which is German index, FTSE, which is UK, Japan, Taiwan, most of them have actually done better than India this year. So it is not an Indian bull market that we are seeing. This is a global bull market, which is what I was talking about. This is an inflationary cycle. So if you ask me, there are pockets where chasing is beginning to happen. If I look at passive money flow in the US, that is again increasing. The same set of 7 stocks are driving the rally. So end of the day, it is going to get further fueled because as you go into year end with the US elections down the curve, Fed would or mostly would be cutting rates, as a result of which you could see another leg up as well. So if you ask me, and this is borderline prediction that I'm doing here, but this is my view, that I think into the year end, markets can continue to go up. When can it correct? Maybe sometime next year. This is what I think. But having said that, to go and take risk in an abnormal way today is something that I would not be comfortable with. So hence, matching prudence, ensuring that bottom-up company selection does not get sacrificed, and ensuring your portfolio does not lose liquidity is where I would focus on. Now, coming to broad promoter sales, see, I think over the last 20 years, one of the things that people forget is when you look at global markets, India is the only market that stands out where public market promoter holding is so high. The average public market, so-called market that we use, public market promoter holding average is roughly around 10 to 15%. In India, that's closer to 35 to 40%, which means when a market matures, it is only natural that promoters or the next generation do sell stake. Now, of course, some of these businesses, many of the promoters are using it as an option to actually monetize value, and there's nothing wrong because they're getting the valuations. So to contextualize and use a broad brush and say everything is overvalued because promoters are selling, I'm not sure that's the right statement to make. But there are 100% pockets where things are overvalued, where things certainly need merit caution.
Understood. Naveen. Thank you so much. I have a question on the sectors. How do you think the automobile sector will grow from here? The outlook?
I think auto is going to see this year consolidation at best. If you look at the data at a slightly more granular level, as close to monthly data, you're already seeing inventory build up. You're already seeing additional supply coming in from companies like a Hyundai, where mutual funds will be forced to buy that IPO as well, because it's one of the largest IPOs that's hitting the market. In next year, you might see another two-wheeler company, which is a private company, come into the public markets with even larger listing. So all of this means auto as a sector can consolidate from here. It is a cyclical sector. We have been on overweight auto for a while now, from 22. We have been trimming, and I'll continue to trim. We'll continue to play bottom-up stories in auto. Growth would actually come because of consumption increasing, but it will be cyclical in nature. If I look at 24, 25 numbers, I think for many of the companies, margins could come under pressure. I think people will begin to realize something that I have been saying. EV is not a structural theme, according to me, especially in the four-wheeler space. I think the government will give more incentives to hybrid. For a market like India, hybrid makes more sense than a pure play EV. I think EVs might take even 10, 15, 20 years to structurally penetrate. It makes more sense in the two-wheeler space than the four-wheeler space. That's my view. So we'll have to be balancing all of this in terms of how we manage bottom-up stock picking here.
Understood. Naveen, another interesting question now. Businesses like HDFC, Infosys have created wealth over the last few decades. Currently, over the last few years, they have not been moving well. So most of the portfolios are moving away from these businesses. Do you think that this is for a short-term gain? It's been moved, or do you look at these businesses for holding this business for a longer-term wealth creation?
So I think the two questions, right? One is managing money as a fund manager, and another is managing money as an individual investor when you do it yourself. And the answer differs for both, because end of the day, the answer will not differ if I lock in your money for 10 years. The day I give you daily liquidity, which is what we do, you can redeem funds whenever you want. It's as simple as sending us an email with a redemption notice and we have to redeem. So this definition of longer term to me makes no sense, because I don't know when you're managing a pool of money what long term means for each person. I'll tell you how we think about it and maybe how individual investors can think about it, and then the answer could be different for both. Now, as far as I'm concerned, like I said, banking as a structural theme is over. I don't think this decade, and I've made this as a controversial statement in 23, and I continue to make this as a controversial statement in 24. I think this cycle in the next 3 to 4 years, Nifty banking index will underperform Nifty, because where you're going to see this cycle move is more so into an inflationary sector. Banking has more competition. If what I'm saying is right, where money flow into the markets is structural, which means your cost of funds are also going to be under pressure, which means structurally as an industry, your NIM margins can go under pressure, which means ROAs can contract. I don't see this changing. So effectively, we would play banking from a bottom-up tactical perspective. If you had seen Itus pre-21, we owned ICICI Bank structurally, we owned HDFC Bank structurally, we owned Axis Bank structurally. Today, none of them, according to us, are structural. They still can give you a 12-13% IRR. I'm not saying they cannot, they will. But is that there is a certain merit for holding certain part of that. But I think to get a re-rating on top of that, because last decade, the price to book for HDFC Bank was 4, and hence this decade at 2.5, it looks cheap. I'm not sure I completely buy into that argument yet. So if you ask me, it's a great business. It will continue to be a great business, but it will go through cycles. In the last 20 years, those cycles were not really felt. This decade, I think it can get felt in slightly more. So that's the way we would play banks. But for an investor who's held HDFC Bank structurally, who's not looking at monthly returns, quarterly returns, yearly returns, and saying that I'm building a portfolio for the next generation, I don't think what I'm saying needs to have too much of merit for them, because for them, they are building 10, 20, 30-year portfolios, which is not what we are doing. So I think the decision making has to get contextualized with what you are doing.
Understood. Got it. With technology advancements coming in AI and everything, now how do you see that impacting investment strategies in the future?
Investments, I mean, end of the day, everyone is going to, you'll see more fund managers say that they use AI, yeah, for sure. Because if they don't say that, then investors will not treat them properly. So all of these buzzwords, we've seen multiple buzzwords in the past. Earlier, let's say in the 90s, if you were a fund manager, your edge was in reading balance sheets. Today, if you're a fund manager, your edge is in very few people read balance sheets today, because even before a balance sheet is out, 30 people have analyzed that balance sheet and have sent you what to do. So end of the day, today, there is 20 years back, there was too little information. 20 years today, as we speak, there is too much information. And maybe 10 years down the line, the information overload is only going to increase. So people who rely on AI will generally, I believe, tend to become even more lazy. And hence, investing decisions will look like it is becoming easier. But I think the complexity, the ability to basically marry emotions and data will always have an edge. So I think technology has a role to play. For example, even we use significant amount of technology in terms of our initiatives around how we assimilate and build data. That part of it is never going away. That part of it will always be relevant. But I think the human element for investing will not go away. There will always be quantitative, quant-based models that will all increase. But I still think there will be a role for a human end of the day, because investing is not so much just around reading balance sheets and understanding data. There is a psychological edge to investing as well. The day the computers can capture psychology as well, that day humans can get irrelevant. But till that day, I think there is a good interplay between humans and technology.
Thank you, Naveen. I mean, this question comes to you every time. So, is it a good time to invest money? How do you see capital inflow to the portfolio?
So again, I know this often gets asked, because end of the day, when markets keep going up, everyone feels they've missed out. There is always more money in the pocket than what you want to be investing. When markets keep going down, there is a lot more fear. This is the nature of markets for the last 150 years, and this will continue to be the nature of markets for the next 150 years. Nothing is going to change. But if you ask me, rather than answer the question, is this a good time to invest? I will slightly work from a top-down perspective. I'll look at an investor and ask them to answer how much of money are they comfortable putting in equities. Let's say that number is 100. If that number is 100, I will basically say at least get yourself close to 65 to 75 deployed today. And try and keep your portfolio slightly more liquid than normal. Don't take undue risk. There are companies that will keep going up every day. You will have to shut down that noise. You're actually going for quality today and more disciplined investing today. And that residual 15 to 20% cash that you keep, if you do get a correction, over the next 4 to 6 quarters, which I think you will get a better opportunity again to invest. But if you don't get a correction, at least you know that there is no opportunity cost or regret, because what I'm seeing today is mutual funds who basically shut down flows, saying that market is overvalued, reopening it up again. So there are initial signs of greed building up in the market. How long it can last? It can last 6 months, it can last 8 months, it can last 12 months also. But these are not healthy signs. And I see multiple people chasing the market over the next 6 months. That's my view. So rather than chase, I think having a top-down strategy and allocating makes more sense rather than saying that I want to go all in today, which I don't think is prudent either.
Understood. Thank you so much for the questions and the answers. Maggie, over to you.
Thanks, Naveen and Ajit, for the interesting insights and for the Q&A session. I once again thank you all for your patience on the call. The recording of this webinar will be sent out once it's available. Wishing you all a happy weekend. Thank you.
Thank you so much for your time.